One of the most important things to consider when you're looking to buy a whole life insurance policy is what your objectives are for that policy. How do you plan to leverage it as a tool in your life specifically? When will you need access to the capital? What will that capital be used for? I don't know if you know this or not, but Life 180 is an acronym for Living Intentionally for Excellence. I always encourage people to understand how this financial asset fits into their life before they begin using it in their financial strategy. Depending on what your objectives are, there are two elements inside the policy that will have the greatest impact in making sure the policy design is in alignment with what your objectives actually are. Those two elements are the base in the policy and the paid up additions or PUAs inside of the policy. What you need to consider with the base and the PUAs is actually how they impact the policy both short-term and long-term. Every good policy will have some sort of blend of base premium and paid up additions. Base premium will perform better in the long run, while paid up additions will give you much faster liquidity of your money. The way I teach my Life 180 coaches to build policies is to leverage paid up additions to provide early liquidity while using the base premiums to help drive the growth of the policy as that policy matures. More base is going to perform better over the long-term life cycle of the policy. Let's call it 40 years. The challenge is most people are not wanting to delay gratification for 12 plus years before it starts to actually get efficient. I get it. I wouldn't want to do that either. That's why my favorite way to design a policy whenever you can is to do what we call a front load of PUAs of an amount that is significantly higher than the annual premium to get the policy started. For example, let's say you had $100,000 sitting in a savings account, CD, bonds, or another financial vehicle that you wanted to eliminate risk from. You could use that money as a front-loaded PUA to start the policy. Then you could take roughly 10 to 12% of that number annually and have that be your premium with a higher base. This will help keep a high percentage of liquidity going into the policy for year one. For example, you contributed $112,000 and you would have liquidity of roughly $103,000, which means you're going to have over 90% liquidity of the money that you contribute to the policy in year one. That's really hard to do. Then in year two, when you make your contribution of $10,000, the policy is actually growing by more than you're contributing right out of the gate. And from there, it just gets better and better and better every single year. And that is why I call this the most powerful financial tool on the face of the earth. By you giving up a small percentage of liquidity in year one, you create a financial system that will enable you to accelerate your growth on a predictable basis with less risk. There's literally no other financial tool in the world that can do this for you. If you want to learn how a properly designed whole life insurance policy can fit into your life, set up a free clarity call with one of my Life 180 coaches using the link below. Have a blessed, inspirational day, and we'll talk soon. See ya.